In April 2012, the most respected bank CEO in America stood before investors and dismissed rumors of massive trading losses as a tempest in a teapot. 3 weeks later, Jamie Dimon would eat those words as JPMorgan Chase announced a $2 billion loss that would eventually balloon to $6.2 billion. The culprit? A single trader in London whose bets had grown so enormous that he could move entire markets just by placing an order. Other traders called him the London Whale because his trades created waves across the financial ocean. This wasn't supposed to happen. After the 2008 financial crisis, banks promised they'd learned their lesson about risky trading. JP Morgan had survived that crisis better than any other major bank. They were the responsible ones, the smart ones. Yet here they were, losing more money in a few months than most people could comprehend in a lifetime. And the craziest part? They lost it all while claiming they were actually reducing risk. Today, you'll learn how the safest bank on Wall Street lost billions through trades so large they warped the market itself, and what this means for your money sitting in banks right now. If you want to understand the economic stories that shaped our world while most people were sleeping, hit that subscribe button, ring the notification bell. This channel uncovers the financial mysteries that affect all of us, because understanding how billions can vanish overnight is the first step to protecting your own wealth. Please also like this video. Thanks. Chapter 1. The Setup, the Safest Bank on the Street. To understand how JP Morgan lost $6.2 billion, we need to start with why everyone thought they were invincible. In 2008, while Bear Stearns collapsed and Lehman Brothers died, JP Morgan stood tall. They even had enough strength to buy the failing banks at government-brokered fire sales. CEO Jamie Dimon became Wall Street's golden boy, the banker who'd been smart enough to avoid the toxic mortgages that poisoned everyone else. By 2012, JPMorgan Chase was America's biggest bank with $2.3 trillion in assets. To put that in perspective, that's more than the entire economy of Italy. Dimon had built a reputation as the best risk manager in banking. He famously knew every detail of his bank's positions and would grill traders about their strategies. The bank's stock had recovered from the crisis faster than competitors. Investors loved them. Regulators trusted them. But inside JP Morgan's London office, something strange was happening in a division most people had never heard of, the Chief Investment Office, or CIO. This wasn't where the bank made loans to businesses or helped companies go public. The CIO's job was supposedly boring. Take the extra cash the bank had from customer deposits and invest it safely while the bank waited to make loans. Think of it like this. When you deposit money in your checking account, the bank doesn't just let it sit there. They invest it in super safe things like government bonds until you need it back. The CIO managed about $350 billion, more money than the entire economy of Denmark. The unit was run by Ina Drew, one of the most powerful women on Wall Street, who'd been with the bank for 30 years. She was known for being conservative, careful, and completely trusted by Dimon. Under her watch was a trader named Bruno Ixil, working in London. Ixil was a French mathematician who joined the bank in 2005. He was quiet, analytical, and supposedly focused on protecting the bank from risk. Here's where our story takes its first twist. The CIO wasn't really investing in simple, safe government bonds anymore. They discovered they could make more money using complex financial instruments called derivatives. Derivatives are basically bets on whether something will go up or down in value, like betting on whether interest rates will rise or fall. The bank claimed these weren't risky bets, but hedges, insurance policies protecting the bank from losses elsewhere. Imagine you own a house in Florida. You buy hurricane insurance to protect against storms. That's hedging. But what if you started buying hurricane insurance on every house in Florida, then betting on whether hurricanes would hit? That's not hedging anymore. That's speculation. And that's exactly what was starting to happen in JP Morgan's London office, though nobody at headquarters seemed to notice yet. Chapter 2. The Build, when hedging becomes betting. By late 2011, Bruno Ixil was making bigger and bigger trades. But these weren't normal trades you or I might understand, like buying Apple stock. Ixil was trading in something called credit default swaps on an index called CDX.NA.IG9. Don't let the jargon scare you. Here's what this actually means. A credit default swap is basically insurance on corporate debt. If you own bonds from General Electric and worry they might not pay you back, you can buy a credit default swap as insurance. If GE defaults, the swap pays you. The CDX index IXL was trading was like a basket of insurance on 121 different companies all bundled together. When IXL bought these swaps, he was essentially betting that American companies would stay healthy and not default on their debts. At first, these trades made money. Lots of money. In 2010, the CIO made $1.3 billion in profit. In 2011, another $900 million. The bank's executives loved it. Here was a boring division that was supposed to just park cash safely, and instead it was printing money. Ina Drew became one of the highest paid executives at the bank, making $14 million a year. IXL was seen as a genius. But success bred appetite for more success. The trades kept getting bigger. By December 2011, IXL had built up a massive position. He wasn't just buying a little insurance here and there. He owned a huge chunk of the entire market for these credit default swaps. It was like one person buying up 90% of all the hurricane insurance in Florida. This is where the London Whale nickname was born. In early 2012, hedge fund traders started noticing something weird. Every day, like clockwork, massive orders would hit the market in these credit derivatives. The orders were so large, they would actually move prices. Traders realized these orders were all coming from the same source, someone at JPMorgan in London. They started calling this mysterious trader the London Whale, or sometimes Voldemort, because his presence in the market was so powerful and ominous. Here's what was really happening. IXL's position had grown so large that he couldn't get out without losing money. It's like trying to sell 10,000 houses in a small town all at once. You'll crash the price. So instead of selling, IXL did what desperate traders often do. He doubled down. He started making even bigger trades to try to offset his losses. The math was getting scary. By March 2012, the notional value of IXL's positions, the total amount of insurance he'd sold, exceeded $157 billion. That's more than the entire economy of New Zealand. And remember, this was supposedly a conservative unit just investing excess deposits safely. Inside JPMorgan, risk managers were starting to raise alarms. The bank had risk limits, rules about how much any trader could lose. IXL's positions were breaching these limits, but instead of forcing him to reduce his trades, something incredible happened. The bank changed how it measured risk. They literally rewrote the rules to make the positions look safer. It's like a dieter changing their scale to show lower numbers instead of actually losing weight. Chapter 3. The breaking point. The whale surfaces. On April 6, 2012, the financial world woke up to explosive news. The Wall Street Journal and Bloomberg published stories about the London Whale and his massive trades. The articles suggested JPMorgan might be taking huge risks with depositor money, the very thing banks weren't supposed to do after the 2008 crisis. The timing couldn't have been worse. Congress was debating the Volcker Rule, a new regulation that would ban banks from making speculative trades with customer deposits. JPMorgan had been arguing they needed flexibility to hedge their risks. Now it looked like they were doing exactly what regulators feared, gambling with depositor money. On April 10th, JPMorgan reported first quarter earnings. During the analyst call, someone asked Jamie Dimon about the London Whale stories. Dimon's response would haunt him. "It's a complete tempest in a teapot. Every bank has a CIO. We invest that money in very high-grade, low-risk securities." But behind the scenes, panic was setting in. The hedge funds, smelling blood in the water, started betting against JPMorgan's positions. They knew the whale had to unwind his trades, and they positioned themselves to profit when he did. It was like sharks circling a wounded swimmer. Boaz Weinstein, a hedge fund manager who'd actually helped train Bruno IXL years earlier, was one of the sharks. His fund, Saba Capital, had noticed the weird price movements in the credit derivatives market. They realized JPMorgan's position was so large it had actually distorted market prices. Weinstein started betting against the whale, knowing eventually the positions would have to return to normal prices. By late April, the losses were accelerating. Every day, IXL would come in to find his positions had lost tens of millions overnight. April 13th was particularly brutal, a single-day loss of $415 million. The London team tried desperately to stop the bleeding, but it was like trying to plug a leak in a dam with your fingers while new cracks kept appearing. The really damaging part was that everyone now knew JPMorgan was in trouble. When you're the only seller in a market and everyone knows you have to sell, Buyers disappear or demand massive discounts. The bank's own traders described it as being in a corner, trapped with no good way out. On May 4th, Dimon held an emergency meeting. The losses had reached $1.4 billion and were growing daily. The decision was made: admit the problem publicly and start unwinding the positions, whatever the cost. The myth of JPMorgan's invincibility was about to shatter. Chapter 4. The Fallout. The Confession. On May 10, 2012, Jamie Dimon hosted an emergency conference call with investors. The master of Wall Street had to eat his words from just a month earlier. "We've had significant losses in our synthetic credit portfolio," he admitted. The initial estimate? $2 billion in losses, with potential for another billion more. The reaction was swift and brutal. JPMorgan's stock fell 9% in a single day, wiping out $14 billion in market value. But that was just the beginning. Dimon admitted the trades were flawed, complex, poorly reviewed, poorly executed, and poorly monitored. Coming from the CEO who'd branded himself as Wall Street's best risk manager, this was stunning. The sharks smelled more blood. Hedge funds that had bet against the whales' positions made fortunes. Boaz Weinstein's fund reportedly made $250 million. Blue Mountain Capital made $300 million. They weren't doing anything illegal. They were simply taking the other side of bad trades. But it showed how sophisticated investors could profit from a major bank's mistakes. Inside JPMorgan, heads started rolling. Ina Drew, the executive in charge of the CIO, resigned on May 14th, giving up millions in compensation. Bruno Ixel, the London whale himself, was stripped of his trading authority. The bank launched an internal investigation that would eventually reveal stunning failures at every level. But the losses kept growing. By the end of May, they'd reached $3 billion. June brought another billion. By July, when the bank finally finished unwinding most of the positions, the total loss had reached $5.8 billion. Later revisions would push it to $6.2 billion, 3 times Dimon's initial estimate. The regulatory response was fierce. The FBI opened a criminal investigation. The Securities and Exchange Commission launched a probe. The Commodity Futures Trading Commission started digging. Congressional committees scheduled hearings. Senator Carl Levin called it a textbook illustration of why we need a strong Volcker rule. The investigation revealed damaging details. Traders had nicknamed their portfolio the caveman because it was so primitive. They'd kept spreadsheets with hundreds of manual entries that contained errors. Risk managers who questioned the trades were overruled or ignored. The London office had mismarked positions to hide losses, essentially lying about how much money they were losing. Perhaps most damaging was the revelation that while Ixel was building these massive positions, JPMorgan was telling regulators they were reducing risk. Documents showed the bank had changed its risk model in January 2012, which magically cut the reported risk in half overnight. It wasn't that the trades got safer. They just changed how they measured danger. Chapter 5. The Aftermath, Consequences, and Cover-ups. The London whale scandal's aftermath stretched for years and reshaped how banks operate. In September 2013, JPMorgan agreed to pay $920 million in fines to 4 different regulators: the SEC, Federal Reserve, OCC, and Britain's FCA. They admitted to unsafe and unsound practices and conducting banking business in a manner that jeopardized its safety and soundness. The human toll was significant. Bruno Ixel, the London whale himself, escaped criminal charges by cooperating with prosecutors. He turned over emails and recordings that showed his superiors pressured him to hide losses. His boss, Javier Martin Artajo, was charged with conspiracy and wire fraud, but fought extradition from Spain. Another trader, Julien Groot, was also charged but remained in France, beyond U.S. reach. The investigation exposed a culture of deception. Recorded phone calls revealed traders joking about their fake numbers. In one call, a trader said they needed to show a loss of just $200 million when the real loss was over $1 billion. "I can't do it," the trader said. "It's just too far from the truth." For Jamie Dimon, the damage was personal. The man who'd weathered the 2008 crisis with his reputation intact was now tarnished. His 2012 compensation was cut in half to $11.5 million. More painfully, he was forced to appear before Congress for hostile questioning. Senator Jeff Merkley asked him point-blank, "Will you apologize for betting with insured deposits?" Dimon's carefully worded responses satisfied no one. The scandal gave ammunition to those pushing for tighter bank regulation. The Volcker Rule, which JPMorgan had been fighting, was strengthened. Banks were forced to prove their trades were truly hedges, not speculation. The definition of proprietary trading, betting with the bank's own money, was expanded. JPMorgan had to add 3,000 compliance officers and spend an extra $1 billion annually on controls. But perhaps the most lasting impact was on the bank's culture. JPMorgan had to submit to an independent monitor reviewing its risk controls. Internal emails released during investigations showed a bank that had grown too confident, too complex, and too willing to bend rules. The CIO, once a profit center, was restructured and shrunk. Its remaining assets were moved to the Treasury Department where they belonged. The London whale also changed how markets work. Regulators realized that banks had grown so large that a single trader could distort entire markets. New rules required banks to report large derivative positions. Trading in credit default swaps became more transparent, with more trades required to go through central clearinghouses instead of private deals. Yet for all the penalties and reforms, JPMorgan survived and eventually thrived. The bank earned $21 billion in profit the same year it lost $6 billion to the whale. Its stock price recovered and eventually reached new highs. Jamie Dimon kept his job and rebuilt his reputation. Some argued this showed the system was still broken, that banks could lose billions, admit to crimes, and still prosper. Chapter 6. The Human Lesson: What This Means for Your Money. So what does a French mathematician in London losing $6 billion mean for regular people? More than you might think. First, it proves that even 4 years after the 2008 crisis, the biggest banks were still taking massive risks with customer deposits. When you put money in a checking account at a major bank, you assume it's safe. The London whale showed that assumption might be naive. The scandal revealed 3 warning signs every investor and bank customer should watch for. First, complexity is often a mask for risk. When JPMorgan's own CEO couldn't explain what the CIO was doing, that was a red flag. If you can't understand how a bank or investment makes money, that's dangerous. Second, when financial institutions change their risk measures or accounting methods, pay attention. It's like a student changing their grading scale. Usually, not a good sign. Third, size matters. When any institution becomes so large that its mistakes can distort entire markets, systemic risk emerges. For your personal finances, the lesson is clear. Diversification isn't just about spreading investments across different stocks. It's about spreading risk across different institutions. The London whale reminds us that even the safest banks can lose billions overnight. That's why FDIC insurance exists, but it only covers $250,000 per account. If you have more than that, spread it across multiple banks. Finally, the London whale proves that financial reforms are never complete. The Dodd-Frank Act was supposed to prevent this kind of speculation. It didn't. The Volcker Rule was meant to stop proprietary trading. JPMorgan found a loophole. As long as there are rules, smart people will find ways around them. That's why individual vigilance matters more than regulation. Today, as banks push into cryptocurrency, artificial intelligence, and other complex new areas, remember the London whale. When someone tells you they've found a risk-free way to make money, when trades get too complex to explain, when positions grow too large to unwind, those are the moments when billions can disappear. The London whale swam in 2012, but the ocean of financial risk remains deep and dangerous. If stories like this fascinate you, where we uncover the economic events that shaped our world while most people weren't paying attention, hit subscribe, because we're just getting started with these financial mysteries.